Your biggest customer may actually be one of your worst customers. They buy $200,000 from you every year, so you call them a VIP customer. But they demand discounts. They pay late. They consume your employees' time. They constantly ask for extras, and you're terrified of losing them. Here's the question most business owners never ask. After everything it costs me to serve this customer, am I actually making money? Because big revenue does not automatically mean big profit. Hi, I'm Us Melbourne, founder of Melbourne Accounting Solutions. Today, I want to challenge one of the most dangerous assumptions in business. Your biggest customer is automatically your best customer. Maybe they are, but maybe they're not. Because most businesses track sales by customer. Far fewer understand profit by customer. And that difference can completely change how you run your business. Let's imagine Sarah owns a growing service company. Her largest customer generates $250,000 a year in sales. That's approximately 20% of her company's revenue. Whenever Sarah talks about the business, she proudly mentions this customer. Then, one day, she decides to analyze the account properly, and she discovers something shocking. The customer generates revenue, $250,000. But now let's look deeper. Direct labor required to service the account, $110,000 materials, and outside services, $55,000. Now we're down to $85,000, but we're not finished. The customer negotiated special pricing, requires priority service, frequently changes orders, needs work corrected, calls employees constantly, and takes approximately 75 days to pay. Sarah even has one employee spending a significant amount of time managing this account. Once she starts considering the full economic cost of the relationship, that $250,000 customer doesn't look nearly as attractive. And here's the real problem. Sarah has been giving this customer her best price, her best employees, her fastest service, and her longest payment terms. Why? Because they're our biggest customer. Think about that. Sometimes the customer giving you the most revenue has enough bargaining power to take away much of your profit. Lesson has shown. Revenue doesn't tell you customer profitability. Imagine two customers. Customer, annual sales, $200,000, gross margin, 15% contribution before other costs, $30,000, and they pay in 75 days. Customer B, annual sales, $100,000, gross margin, 40% contribution before other costs, $40,000, and they pay in 10 days. Which customer is bigger? Customer A. Which customer may be more financially valuable? Customer B. That's why I want business owners to stop ranking customers only by sales. Lesson #2, time is a cost. Here's a cost that rarely appears clearly on an invoice, your time. Some customers require one phone call, others require 20. Some accept your standard process. Others require special reporting, custom invoices, constant meetings, rush orders, after-hours calls, revisions, complaints, and exceptions to every rule. Your employees are being paid while providing all that additional service. That means the customer is consuming resources. If you're not measuring those resources, your profitability analysis may be incomplete. Lesson #3. Slow paying customers are using your money. Suppose you invoice a customer $100,000, but they don't pay for 90 days. During those 90 days, your employees still need their salaries. Your suppliers still need payment. Rent is still due. Taxes are still due. So who finances the customer's 90-day payment cycle? You do. Maybe through your bank account, maybe through your line of credit, maybe through credit cards. Now the customer isn't just buying from you. You're helping finance their business and potentially paying interest to do it. Lesson #4. Customer concentration can become dangerous. Now let's make the problem even bigger. Suppose one customer represents 40% of your revenue. What happens if they leave tomorrow? You don't necessarily lose 40% of your expenses at the same time. You may still have employees, rent, vehicles, insurance, loans, software, management salaries, and other fixed costs. That's called customer concentration risk. A major customer can help build your business, but becoming financially dependent on one customer can also make your business vulnerable. Your best customer isn't necessarily the one who buys the most. It's the one who creates the most sustainable value for your business. Revenue matters, but so do margin, payment speed, cost to serve, risk, and the resources required to maintain the relationship. Build a customer profitability report. Here's something I want you to consider doing. Take your top 10 customers. For each customer, calculate or estimate. 1. Annual revenue. How much do they buy? 2. Gross profit. How much remains after direct costs? 3. Discounts. How much margin are you giving away? 4. Cost to serve. How much employee and management time do they consume? 5. Payment behavior. Do they pay in 10 days or 90? 6. Problems and rework. How much additional cost does the relationship create? 7. Concentration risk. What percentage of your company depends on them? Now, rank your customers again. You may be surprised by what you discover. Does this mean fire your biggest customer? Not necessarily. That's not the lesson. Once you understand the economics, you may have several options. Raise the price, reduce unnecessary discounts, change payment terms, require deposits, charge for additional services, standardize the work, renegotiate the contract, improve efficiency, or, in some situations, decide the relationship no longer makes financial sense. But you can't make the right decision until you know the numbers. The question most business owners are afraid to ask: imagine losing a $300,000 customer. At first, it sounds disastrous. But what if losing that customer allows you to eliminate $280,000 of costs? Stress, overtime, rework, financing pressure, and operational disruption. Maybe you didn't lose a $300,000 customer. Maybe you lost a $20,000 problem. That's why accounting should do more than tell you how much you sold. It should help you understand where you're actually making money. At Melbourne Accounting Solutions, we want business owners looking beyond the total revenue number. We can help you examine customer profitability, gross margins, accounts receivable, pricing, discounts, labor costs, cash flow, and customer concentration. Because sometimes the answer to increasing profit isn't finding another 100 customers. It's understanding the customers you already have. If your business has strong sales, but you're not sure which customers are actually producing your profit, contact Melbourne Accounting Solutions. Let's follow the numbers. Look at the largest customer in your business and ask, if I calculated every dollar and every hour required to serve this customer, would I still call them my best customer? If you don't know, that's exactly why you should calculate it. I'm Everald Melbourne, founder of Melbourne Accounting Solutions. Our mission is simple: to help Canadian business owners make smarter financial decisions, reduce unnecessary taxes, keep more of what they earn, and build stronger businesses. If this lesson made you think differently about your customers, subscribe to the channel. We're going beyond bookkeeping and taxes to talk about the numbers that actually drive your business. And if you want to know which customers are truly making your company money, contact Melbourne Accounting Solutions. Let's turn your accounting data into better business decisions, helping Canadian business owners learn, grow, prosper. Thanks for watching, and I'll see you in the next lesson.